Very happy to welcome Craig Manchuck, Vice President and Portfolio Management at Osterweis. Craig, welcome to Forward Guidance. I want to ask, how is it in the land of bonds? I know that the long duration part of the market is just really getting hammered. Looking at something like the ultra long duration, 25 year zero coupon stuff from peak to trough, it's down close to 65%. So, what's it like to be in a market where duration has suffered, and what have been your and your funds views on interest rate risk, and what are they now?
Well, good morning, Jack. Thanks for having me. It's been an interesting time the last 2 years for sure. We are inundated with just a plethora of opinions from lots of different people and different angles, and everybody's trying to call the top of the market and what we should be doing next. It's been pretty remarkable to see the magnitude of the drawdown. Not terribly unexpected, but the magnitude, because people have just gotten so conditioned for so long to very, very, very low rates. And that's not been the norm over my career. And, if I look at the arc of my career going all the way back into the mid 80s, um, we just went by the 36-year anniversary of the crash of 87. I was in the markets working at that time. And I wish I had I have a printout saved somewhere of all the stock price moves that were on my machine that day. It was pretty remarkable. But that happened because we had an environment where the long treasuries were over 9%. And so, it's not unusual for me to see, us approaching 5% on the 10-year right now. It just so happens that over the last 15, 16 years, ever since the financial crisis, everybody just assumed, all right, we're in this really super low rate environment. And most of the professionals in the market have operated only in that kind of regime. So, um, my two partners and I guess, some would call us old fashioned. I don't really like to use that term because it sounds kind of dusty and old, but I think we're just pretty careful in particular, and realized that it was very clear that there was going to be significantly higher rates, that the Fed was going to have to do something dramatic to turn off the spigot here of just free money, and it was fueling inflation that was running out of control. So seeing where we've gotten to today um, doesn't really surprise us. I mean, we've been saying for a long time we have not been willing to extend duration out into this. We've had dozens, maybe more, economists that we've talked to and met with have told us 3%. Now's the time to extend duration, and it was 3.25, and then 3.5, and then 4. And and more recently 4.5. There is a very well-known economics advisory firm that was in our office recently, and they came and said, now's the time to be extending duration. Right? Everybody's trying to make a call, and that was 4.5%. Here we are knocking on the door 5. So where does it stop? I don't know. We don't have a crystal ball, and we're not in the business of making bets. And for us to make a call like that would be making a big bet. Because if we're wrong, there are still some significant drawdowns and capital losses that you'll take in the short run on, trying to get the exact top of the market and figure it out. So our thinking is that the Fed has been very clear all along in their intentions. They want to be data dependent. They will continue to hike until they feel like the data signals that they can sort of back off and ease off. However, um, once they do turn, we think they'll be equally transparent and clear about their intentions to actually bring rates down. And at that point, we'll start to probably get more comfortable extending some of the duration out further into the market.
So duration is interest rate risk, and credit risk is the risk that you don't get paid back. So you have you bobbed and we've dodged a lot of the losses on the duration front by sticking to the short term of the market. And even now, with the 10-year at 5%, you don't if the economists were to come in your office now, knock knock, and say, "Hey, 5%, now's the time." You're not saying that now. You want to wait until the Fed cuts.
We don't have a hard, fast target. It's kind of a moving target. I think I joke around with my partner Carl. When we were at 3, he said, "Oh, at 5, I'd be buying." Well, now we're at 5. He goes, "Well, maybe at 6." It's all dependent really on the tone of things around us, right? What we're seeing in terms of inflation. We continue to see signs of inflation, various pockets all over the place. We were just talking yesterday about concert tickets. Right? I mean, the price of the Taylor Swift concert tickets were out of control. They're $300 face value, and then by the time people actually get them in their hands, some are paying $1,000 for that. That seems incredibly, incredibly high to me. Same thing with sports tickets, tickets to ball games, entertainment. Younger generation is much more interested and intent on experiences. So I think the experiential um, services part of the economy continues to inflate, and probably at a rate that I would think is somewhat unsustainable. But we shall see. Famous last words, right? I don't want to call the top, but we're seeing signs of some of that inflation abating in certain places. But the cost of, I mean, oil today is up another 3%. So gasoline out here in California is just about $6 for everybody, which is a crazy high number. People have to pay it. Um, Food prices have actually sort of abated somewhat. Chicken prices are actually down. They've been down sort of quite a bit off the highs. So there are areas where we have seen prices correcting. Some of the other commodity markets, as they relate to sort of China's consumption of industrial metals, commodity prices have come down. So we're seeing that in aluminum, copper, some of those other things that aren't part of the necessarily part of the EV component package for EV batteries. Most of the rare earths and things in that cohort are still quite elevated.
When looking at the short duration fixed income market, what have you liked and what do you like now in the high yield bond, the loan market, convertible securities, and why? And also, I know that Joe, I'll say this so you don't have to. There's no such thing as the high yield market. Like each bond is its own thing. But just looking at St. Louis Fed, the high yield index spread is 4.37. So whatever the duration is, that's the risk free treasury, and then on top of that is a little over 4%. Is that attractive to you at this time? As some people say, the people knocking on your door that we're late cycle, they've been wrong so far, but they might not continue to be wrong. They eventually they'll be right. And so, how do you think about that sort of risk reward?
You're speaking my language here. I've been one of the people that said, has been saying for a long time, and we say it to our investors all the time. This is a market of bonds, not a bond market. Every single security is different. Every document is different. The intentions of each of the borrowers is different. So it is the least homogenized or commoditized part of the bond market. And as a result, you know, it plays into our way of investing, which is bottoms up, security by security, bond by bond, company by company. What we just wrote about in our quarterly outlook was the gift horse that we feel that the market's been giving us recently and continues is in the 1 to 2 year investment grade part of the market. There are, it's number one, we do think that eventually the Fed's tightening here will lead to a recession. I don't know when, I don't know how severe, but we do think that there will be a recession at some point. Um, with that, it behooves us to continue to sort of increase the quality of our overall book. We can go and buy whatever we'd like, and we've largely stayed in high yield for the last 15 years because it's been the most attractive part of the market. So, what we like to do, the three of us are probably as chicken as it comes from an investing standpoint, but um, we like to find the most attractive part of the market and then look for the least risky way to play that. Okay. So we're always looking at how do we truncate downside? How do we eliminate downside? Because if we're investing in things that provide us with a fair yield, we're not necessarily looking to sort of step on the gas and play it from the most aggressive end. It's not what our investors want us to do. They like to sleep at night. We like to sleep at night. They don't want to worry that one day we're going to come in and the fund is going to be down, a few percent. That's just not the way we've ever invested, and nor will it be any way that we do in the future. So 1 to 2 year investment grade paper we've been able to find in the 6 and in some cases as high as 7% yields. Now, that's not everywhere. But we have to hunt and find individual securities and really kind of scrounge around and scrape and accumulate positions in that space. Kind of a couple million bonds at a time. So it's not like I can just sort of push a button and say, "Oh, that looks good," and wave it into the portfolio. Right? So there's some limited liquidity features in some of these names, but in other cases, we find securities that have very a couple $1 billion issues, and liquidity is actually quite good. And what tends to happen is if you think about market structure is what allows us actually to do what we do and to do it well. Because most of the marketplace is focused on an indexation model, right? So typically, mutual fund managers have a particular silo or sleeve in which they're operating, whether it's high yield or investment grade. Not as many have this broad mandate like we do. And if you're an investment grade manager, what you're trying to keep pace with is the ag or some investment grade index. Now,
Bloomberg aggregate index. Yeah.
yes, exactly. So most of those indices tend to be longer term, right? They'll have an average duration of somewhere in, could be 5, 6, 7, which means they have bonds that have 10-year maturities, and many in investment grade issues are even 20-year maturities. So investment grade portfolios that are based on that index need a certain amount of beta. And what they like is to try to get the names in there that are going to most closely track that index or outperform it. When they start to see things that roll down on the maturity schedule and get inside 2 years or even down to 1 year, that security can become a drag for them on their performance. So a lot of times what they're looking to do is exit the less index sensitive names and add more index sensitive names. We are the beneficiaries of that because we can opportunistically be at the front end and say, okay, we can be a liquidity provider for you that allows you to get out of the names that you want to exit, provide if they happen to be names we like, and then reinvest your cash elsewhere. So, in years past, banks and investment banks would take that position. But as we've rolled forward from the financial crisis, banks and investment banks keep fewer and fewer and fewer positions on their books. There's much less of a proprietary bias, and therefore they don't get in the way. So, what they're looking for are people like us to be the liquidity providers for their clients on the other side. Somewhat similar happens in the high yield market as well, because the typical high yield investors are also benchmark oriented, and the same thing happens when they get something that's going to be not either falling out of the index because it's getting too short, or they have an opportunity within the capital structure to buy the same name but extend maturity and extend duration and look for a little bit more beta or bang for their buck. They'll exit the shorter maturity paper, which is kind of what we like to buy. And what that enables us to do is buy these at yields that sometimes approximate the yields on the longer dated paper. We can't lock those yields in for quite as long an amount of time, but that's okay. If I can get, 7 or 8% on a 1 or 2 year high yield bond that has 7 year paper that's also yielding something similarly, we like that because what we've done is we've eliminated a lot of the spread risk that we would have had, spread volatility, and or spread widening. It'll impact the longer bonds much more dramatically than it'll impact ours. So in a rising rate environment, the natural way that we invest works really, really well because we don't have the exposure in anywhere near the magnitude that most of the index-based funds do out in that longer part of the curve.
So if you're competing against an index, beta is how much you're going to be correlated with that index roughly. So for S&P 500, if I'm an equity manager, Apple is 6 or 7% of the index. So if I don't have Apple, I got to have something that replicates Apple, which is very hard. In your world, the Bloomberg Ag Index, it has a lot of duration, a lot of 20 or 30-year bonds, and so the beta is kind of duration. So everyone, the investment, the Bloomberg the index for bonds is overweight duration, or maybe it's not overweight, but it has a lot of duration in
It
it.
has a lot of duration, and so the high yield market has typically had bonds that issue in the 5 to 10 year tenor when they're originally issued. The investment grade market can go out to 30 and even 50 years at times. So the ag covers, is the broadest measure because that's covering everything. The investment grade indices themselves, are going to look somewhat different than that because the ag will also have components of all the other markets that are out there in there. So, but we use the ag as a benchmark. However, we're really absolute return focused. So I say benchmark agnostic, and from an investment standpoint, we're aware of what's happening, and pretty much all of our investors will look at us and compare us to some different type of index. They may look at us as a low risk, high yield fund. So they'll compare us to how the high yield index does, and they'll expect that what we should do is outperform significantly in down markets and probably lag a bit in up markets. They'll compare us to multi-sector bond funds and even to some alt credit funds. So we have data and scatter plots that show where we've performed against all those cohorts over a 20-year history, and we like what it shows. It shows that we shows us being above, at least in the middle to sometimes above on the return profile, and far to the left, meaning much lower in terms of volatility and risk. So um, I think it's a good combo to have those characteristics in the portfolio of return in a fixed income portfolio, because most of the people that are investing in fixed income are doing it to provide a stable component of their overall investment portfolio. If they want to add risk, they can certainly do that in equities or in commodities or some other asset class. Fixed income has historically been there as a more safe haven. And so when we created this fund, it was created by Carl and the founder of our firm, John Osterweis, to be the only fixed income fund that our investors would need. So we could actually have the flexibility to move into different parts of the market depending on what the cycle was doing. Now that the cycle we think is headed closer to recession, we're starting to shift more into higher quality investment grade and out of the high yield sector. And certainly within high yield, we've invested far away from the riskiest parts of the high yield market. So, and continue to do so.
If you said you're getting right now yields in the investment grade world of 6%, or even 7%, the 2-year treasury is at 5%. So you're getting a spread of 100 to 200 basis points. Is that historically less of the spread than the stuff you were investing in when yields were zero?
We did not keep anywhere near as big a of an investment grade book when rates were low. We just never thought that there was any significant amount of value. There were periods in the past where we actually we had moved and started to move more significantly into floating rate investment grade bonds. That was back in 2018, I believe, at a time when we started to see rates tick up. And so we thought that that was going to be a fruitful place to invest. That change, we had a few taper tantrums in there. And then, of course, with COVID, hitting, we went back down to to that essentially zero rate regime again. So, it worked out fine, but it wasn't quite as positive a return that we would have hoped for. But we're always looking to find ways that we can upgrade the quality of the portfolio if we can, and that doesn't always mean in ratings wise. Sometimes the rating agencies are extraordinarily slow to upgrade companies, and there are some great companies out there that are have very very low leverage, so not a tremendous amount of financial risk of us not getting paid back. They just don't happen to be rated investment grade yet. So, but yeah, we're, like I said, we like to be positive on an absolute return basis. We're not looking to take a whole lot of risk. And one of the reasons, in the big areas of the high yield market that we have been staying away from and been very, very vocal about as being the riskiest out there, is the debt that exists as a result of the leverage buyouts. So companies that are financed in the high yield market that are purchased by financial sponsors, whether it's KKR, Apollo, TPG, Platinum Equity. Um, they've issued huge amounts of debt and make up a very large cohort of the high yield indices. And we have invested far away from them because we feel and have felt for the last 5 or 6 years that that part of the market at some point is going to bust apart because the sponsors have been able to tilt the tables so far in their favor that the historical covenants and documents, the way they were drafted to protect bondholders and lenders, um, they're like Swiss cheese right now. You can throw them out the window. In fact, I won't name the people, but we just had breakfast last week with a couple leverage finance bankers from one of the top 5 underwriting banks in high yield, and they conceded that it's not really even worthwhile to look at the documents of any LBO transaction anymore because the sponsors can pretty much do whatever they want to benefit their equity at the expense of bondholders and lenders. So with that in mind, I don't know why I would ever lend, to a company that's owned by a financial sponsor whose incentives are nowhere near aligned with ours as a bond and a bond investor. They're going to look to take as much money out in the form of dividends and return it to themselves and to their LPs as quickly as possible. And it will come at my expense as a bondholder and my investors. So we see it over and over again. And we're very fortunate because we're not benchmark oriented. So we don't have to buy these bonds. But many of the high yield benchmark strategies, they're forced to buy because these are big parts of the high yield index. And so, as you read in the paper about the coming problems in the junk market, as people like to call it, a lot of those problems will come out of that cohort, and it's because they're the most highly levered. And at the time that they were issued with the future hope of these fabulous synergies from the acquisition or cost cutting that the sponsors were going to be able to put in place. 90% of the time, those never actually materialize to the magnitude at which they're supposed to. And then we're left with, a company that got higher leverage than probably was stated at the time of issuance. Typically, we'll have a large swath of first lien term debt, which is floating rate. So now that rates have risen significantly in the last 18 months, that part of the cap stack is costing them significantly more in terms of interest expense. So we've got a highly levered company, and the wheel's starting to spin faster here because their interest expense is growing. We get into a period in the economy when things start to slow down, and all of a sudden, we think these things are going to bust apart. If they do, the financial sponsor has lots of flexibility to do what they want to do. And we as bondholders would be just stuck sitting there waiting and saying, all right, well, not a whole lot we can do. We've seen some bad actors out there do things that are very detrimental to bondholders, causes bond prices to trade down sharply. And, we just never wanted to be in that spot. So we like to invest away from that cohort for sure.
That is fascinating. So you use the term LBO, leveraged buyout, borrowing money to take a company private. That term now is called private equity, which you'll be much more familiar with. So when I and some of our viewers who track the public markets fairly regularly, is it fair to say that the that what we think of as the publicly traded stocks, and then we can look at their debt structures, that there's a whole part of the market that is something of a black box to us because it's owned by private equity companies, and those bonds are publicly traded. Would those bonds be in high yield ETFs as well, or stuff like that?
Absolutely. And if I look at the components in the some of the big high yield ETFs, the number three component of HYG is Medline. Medline is a medical equipment company that was LBO'd, very, very large company, was family owned, was LBO'd 2 years ago. And so the number three holding is an LBO. And then there's several of them here in the top 10 that are that are LBO financing. So yes, it's a decent sized chunk. I don't have the exact number, but I'm sure it's got to be at least 15% or so of the market, and maybe even larger. And those bonds are typically only bought and sold directly by professionals. And it's because the market is made up of sort of, again, two cohorts. We have publicly issued bonds, which are registered securities, and other bonds that are issued under what's called Rule 144A. And 144A stipulates that unless you're a qualified institutional buyer or um, really an institution, you can't buy those bonds. So you and I can't buy 144A debt as individuals. It's a rule that was set up by the government to protect um, individual investors who may not be as sophisticated from getting taken in a private security transaction. For the most part, these 144As are public securities, right? From an institutional standpoint, they trade, they look, they smell like public securities, but individuals can't own them. So but individuals do own them by way of the mutual funds or the ETFs that they own personally. So those are in there, and I would venture to say that if they weren't part of the index, there are a lot of people out there that would say I would not want to buy this in my fund, and I don't want to own it because I just either I don't like the sponsor, I don't like the structure, I don't like the company, but they're forced to do that. And it's one of the things that makes me happiest, and certainly makes my partners happiest, is that we don't have to do that. I mean, that puts anybody in a bad position. Imagine if you're running a portfolio and 15 or 20% of your portfolio is full of names that you don't want to own, but because you're being forced to compete with that index, you've got to own this stuff. So that's essentially what's happening out there in the investment world. Indexation has really hurt fixed income investors, I think, overall, because it's taken away from many portfolio managers the ability to discriminate against the things that we don't want to own and focus on the things that we do. And that's what makes me so happy. And we're so fortunate that the way our fund was structured 20 years ago allows us to do just that. And that's kind of why we only populate our fund with things that we want to own, and we can eschew all the things that we don't.
Was there a time where this LBO debt was attracted to you? You're being compensated with enough spread, and then also that you had more covenants. And if so, what has changed over time? Describe the process of the things get a little bit looser, rates go lower, private equity performs as an asset class, it gets more trusted. And then also tell us about, why is it Swiss cheese? How are the incentives not aligned? Is it called a dividend recapitalization? And then also the Financial Times, it's an acronym CFO. It's a something financial, consolidated financial obligation. I don't think that's right, but it's basically a packaged security that's collateralized to fund itself. And of course, you
Oh,
you
you mean
saw
like a CLO, the CLO market you're talking about, or the
no, it's collateralized financial obligation, or something where it's a new security.
historically, when this first actually happened, there were lots of protections that were written into indentures and protecting lenders and bondholders. So think about the evolution of the market. What's really fascinating is if you go back 15 years before CLOs or collateralized loan obligations really came into being, the primary lender of term loans were the banks, and that would be J.P. Morgan, Citi, Bank America. So the banks were your primary bank lenders, and historically they made loans. Loans aren't officially securities; they're loans. That they had what's called a term loan A, and then something else called a term loan B. And in addition, then they would also provide revolving lines of credit, revolvers. So the term loan A it still exists in a much smaller way, but a term loan A is a bond is a loan that usually has a floating rate. It used to be based off LIBOR, now off SOFR, and would also have an amortization schedule, somewhat similar to your standard mortgage on a home, right? You'd have to pay down some of the principal periodically. That periodicity would be subject to whatever the lender would ask of the borrower and the borrower, and they would negotiate as to what in fact they could do and what made sense. But the lender really would look at the borrower's business and try to understand how much room and flexibility they needed to give them, but yet draft covenants that would protect them such that if the borrower started to sort of diverge from where they were. Either business went downhill, they started to engage in more risky activities, or let's say a whole new management team came in during the tenor of this loan, and the new management team said, we're going to go out on an acquisition spree. Well, the lenders would actually have the ability to kind of say, can't do that. We're boxing you in a little bit. We've lent to you on this premise. If you're changing the premise, you got to come back to us and renegotiate the terms of this transaction. So that's what started. That's where the business started. That changed as CLOs came into vogue. CLOs became the buyers of those loans, and that's where the term loan B market really evolved. And term loan B market is same obligation as term loan A, but without the amortization requirement. So essentially, it's a loan that you just pay interest on, and then you've got a balloon repayment at some point in the future. You can pay it down periodically if you like, if you have extra capital and you want to sort of pay that off, that's fine. It's prepayable. But the idea was we now have these new buyers, and these buyers at CLOs, they're not the banks. They're buying small pieces of these loans. They're not requiring as much covenant protection, because essentially they're almost viewing these loans like they would a bond. Right? We have this whole portfolio of stuff. We're going to put it in here. We look at it in aggregate. We go out and we borrow our liabilities against that, and that's how we fund this pool to buy these loans. And with that, there was this natural erosion that's happened in these covenant protections. And the CLOs didn't need them the same way, because you didn't have this one big chunk. JP Morgan with 500 million of this loan on their books and saying, you guys better come in here because you're not behaving well.
So they didn't have a lot of, they had skin in the game, but not nearly as much as JP Morgan.
Yeah, the banks, if we fast forward today, the banks are loan arrangers. They tend not to be they're not lenders. They arrange loans, they collect a fee, and then they pass these loans on largely to CLOs. CLOs have grown in such grand scale that they are really the primary buyer of most, certainly most leveraged finance corporate term loans. And so if we think about the financial sponsors, as they look at they're buying a company, they're trying to find how much capital do we have to put in? Where can we generate the highest IRR? And that would be with the lowest amount of equity capital. So let's see how far we can push. How much leverage will guys give us? How much will they require for us to keep in terms of skin in the game? Before they say, no, we're not going to lend anymore. So as the CLO market really took off, the sponsors said, well, this is actually kind of great, because we used to have these maintenance covenants that we'd have to maintain with our bank, and said, oh, if we get over 5 times levered, they're calling us back in and saying, all right, we're going to have to do something. We're going to renegotiate. Bank's going to do something to trap cash and prevent us from having the flexibility we want. Fast forward to where we are now. The CLOs don't have that same stick. They don't have the same incentives to call people in. So the sponsors said, wow, let's do as much as we can in this term loan market, because it's the cheapest funding for us. We can sell it to these CLOs. They keep raising new funds. So they're just going to keep rolling this debt. We never really have to worry about paying it down. We can just keep it out there. And it's the cheapest cost of capital for us. And that's what happened during the entire, post-financial crisis period. Very inexpensive. LIBOR fell to essentially zero. Now, in some cases, the lenders would require a 1% LIBOR floor. But let's say, they'd say, all right, LIBOR plus 350. If you were a, B plus rated company, you could get 4.5% term loan. And you can get that for the most senior secured part of your capital structure. And that might take you from zero down to as much as, historically, the banks would only want to lend to you, 1.5 to 2 times levered through their term loan A's. Well, in the CLO world, that's kind of disappeared. And now we've got 3.5, 4, 4.5, sometimes even 5 times leverage at the term loan level. Great for the financial sponsor because that's his cheapest cost of capital, but not so great for the bondholder who then starts at 5 times leverage and beyond, and then has to be part of that whole cap stack. So the evolution, though, really was precipitated by the growth in the CLO market, and then just over time, some of these deals were fine. Bankruptcies were low. We had a very long run of extremely low bankruptcies because financial conditions were so easy for so long. Rates were incredibly low. And as a result, bondholders became more complacent. Now, some of the indexation in the market also has played into that, right? Because, somebody at BlackRock has got a fund that's benchmarked against, the high yield index, and this big, multi-billion-dollar LBO deal comes with a lot of debt. He can't really say, I can't buy that. I don't want to buy that. I've got to buy it because it's a big part of my index. And if I don't, I'm essentially short that name to the index. So the combination of indexation and CLOs has eroded these financial protections. Passive is another. The ETFs, they have no vote essentially. They won't vote on covenants. They won't negotiate or argue about covenants or lack thereof because they don't really have any kind of financial interest. They're just sort of mirroring the index. That's all they're providing. So they don't have they don't ever look at the world as how they win or lose. They just are, trying to help you keep pace with an index. And as a result, it makes it easier to issue debt with fewer and fewer covenants. So it hasn't been a pleasant path. My partners and I are I say I'm like the Lorax out there from Dr. Seuss, right? I'm standing up there screaming, this structure stinks. This is horrible. We shouldn't allow this to happen because as a bondholder, I'd love nothing more than have great protections out here for myself and for all my other fellow bondholders, because that protects all our investors and protects the asset class. And if the asset class deteriorates to nothing more than a coupon and a promise to repay, that doesn't necessarily lead to a whole host of great outcomes for everybody across that asset class. That's what we kind of concern ourselves with as we, look at each individual security and say, are we getting the right amount of protection here? If we don't have it in the form of covenants, then we need to have it in the form of very low leverage or in a really defensible business. And it certainly does make us, get more and more and more vigilant and rigorous in our analysis of each one of our companies.
And how much of this term A, term B debt is floating rate debt?
That's all floating rate debt.
Okay, all floating
So
rate debt. And does it reset immediately? It has some reset period.
they're quarterly resets, usually quarterly resets. Every now and then some can be semi-annual, but they're generally quarterly resets on those. So as rates go up, you just start to see ticking along the way. You'll see the cost of that capital every we see it in all the companies that have significant amounts of term loan debt outstanding. We just looked over the last year and a half at the interest expense, and interest expense numbers have gone up astronomically. So one of the other important parts here of why this has happened is when we were in a market environment that was very benign, very Fed was very accommodative, and money was very easy. The ability for a high yield company to have significant interest coverage, right? So, what is your interest coverage? How much, how many times are you covering your interest expense? Is
In terms of EBITDA?
yes, and is a measure of sort of financial security and financial well-being. And when high yield companies who had historically been issuing bonds at 10 or 11%, all of a sudden were able to issue at 5, 4, or even 3%, it's much easier to have this huge spread in which you're covering, your interest. So you went from 2 times interest coverage to 5 times. Wow, these guys can handle this debt load really easily. So what then happened is we had what I call leverage creep. And in leverage creep, an old friend of mine told me about, I think it must be 25 years ago now. He said, high yield companies and leverage companies cannot exist for long periods of time at 6 times leverage. Now, we were in a market environment where they were paying 10 or 11% on their debt. He said, but 6 times leverage, it just eats you up. The interest costs eat you up too fast. If you get to that point, you've got to really do something quickly to get yourself back in shape. But 6 times was sort of always an historic problem area. We saw some LBOs getting done at 9, 10, 11 times leverage, real leverage, not what was necessarily what they call this adjusted leverage, because there's a lot of these adjustments to EBITDA that financial engineers use now. Very, very fancy and good for them, but we don't necessarily buy a lot of the adjustments that they want us to sign off on. But it was much easier to do that at very low coupon rates. Well, if you were levered 7 times and all of a sudden rates have now, screamed higher and you had a lot of term loan debt, you're not covering your interest costs all that easily anymore. And that 7 times starts to get really, really painful in the current rate environment. So, that I think what we're going to see going forward, and we've already started to see it, is a lower tolerance for highly leveraged transactions. And that's really where the financial sponsors live. So we haven't seen, if you've noticed it, we haven't seen a lot of M&A activity, and certainly not a lot of issuance in the high yield market by these LBO transactions. It's largely because they can't figure out how can we get the same amount of leverage that we had in the past and make it work and still generate the IRRs on the equity that we're buying.
I started this podcast actually pretty much exactly two years ago, and that was at a time when interest rates were at zero. And pretty much the entire time that the Federal Reserve has raised interest rates, folks have been telling me that the economy can't handle it, that something's going to break. But we stand here 2 years later, interest rates are at 5.5%, and not a lot has broken. Nothing systemic has broken. And now with the benefit of hindsight, everyone knows it now. Very few people knew it then. But the households termed out their debt. With very low coupon mortgage they refied in 2020. I've talked to people who have 2% mortgage rate. Corporations, they borrowed a very long duration, so that investment grade market issued, as you said, 30-year, 50-year bonds. I remember Amazon, reading about Amazon borrowing at 40 years. So those, so I've been struggling to find where is the pain of the higher rates, and it sounds like we were talking about it right now. That's where the pain is. What, if any, hedging goes on with these companies? Are they taking a lot of interest rate risk, because as interest rates go up, their cost is going to go up? Do they enter in some sort of swap to protect against that risk, or what? I've tried a little bit to find that, and I haven't really found much.
Some have nowhere near as many as as thought they would. And you would think here, when the Fed started raising rates, and say like, all right, gosh, any CFO who has a huge floating rate component should be out here looking at swaps. Problem is the minute that happened, the cost of those swaps started to get very expensive. They're like, we're not going to pay for that. We'll just ride it out, because this won't go so far. Because that's essentially what happened. The cost of those swaps became very expensive. So if you didn't do it at the time you had the opportunity to, you just left it alone. But there were actually some, the guys who actually did, if I think about a cohort that did a great job, a bunch of high B or double B rated companies came to market late 2020, throughout 2021. And they started to issue, there was this trend in high yield. They started to extend. So historically, high yield was a 5 to 7 to 8 year market. And they started to issue some 10-year bonds. And the 10-year bonds were largely, the only people that were really able to get it were the stronger credits, so double Bs. And some of these were 4 type coupons. Some of them were 3 type coupons. There was even one issued by Ball Corporation, the guys that make metal containers and cups. They did a 10-year bond with 2 7/8 coupon.
Wow.
And we said, great for them. That CFO should get paid a fortune, because that's going to be fantastic financing for them. And here we are, fast forward today. I want to say the buyers of those bonds, they were part of an index, right? And let me just see where these are. The buyers of those bonds, those they're ball 2 7/8 of 2030 that were issued in 2020. Those bonds are now trading at 77. So those guys have collected 3 years of coupon, so call it a little under 9 points, and they've lost 23 points on the bonds, right? So down 14 points. Now those bonds are double B plus rated; they're going to pay off, and for that's a fairly interesting piece of paper. It's the duration's too long for us to be invested in, but if we were in a different interest rate regime, I'd find that to be very fascinating to be able to buy this debt at 77 cents in the dollar. Then I would feel very strongly that I'm going to get paid off. But the coupon is so low, you know, fantastic job financing their business. So what these double B companies did is they took all their near-term financing risk off the table and extended that out and bought themselves a lot of runway. So part of the reason why you say things haven't broken is many companies did in fact see this coming and position themselves for a higher rate environment. They knew that the end of free money was approaching. And those that did really set themselves up well and created an awful lot of flexibility. The ones that didn't, that are, we're reading articles today about the refinancing wall that's coming, and everybody's worried about the refinancing wall. We've heard about refinancing walls, walls of maturity that have been out there for 30 years. There's always a wall that's coming up.
There's always a wall.
They'll come to market. There'll be ways around it. There's so much cash that's out in the market, whether it's public markets here or private credit. If you're a good company, you're going to figure out a way to get yourself financed, and there's going to be somebody who's going to be willing to do it for you. If you're a lousy company with too much leverage, you may have some problems.
Okay, so some companies hedge, and the best hedge is just to issue long duration rather than issuing floating and having to enter the swaps. But what about that market we were talking about earlier, the LBO debt market, companies that were taken private by private equity?
Some may have hedged, but not a large component. A friend of mine who works at a pretty big lending bank in the southeastern U.S. And they do a lot of revolving credit facilities. It told me that on their book, when they lend the revolver side of the business, they're not lending term loan Bs, but he said on their book, I think his number was under 15% of the companies that had borrowed in the term loan B market had swapped out their floating rate exposure for fixed. So there's a large group, and as I said, we've seen it. We just look at the quarterly numbers, and the quarterly interest expense numbers, go through the roof, and there's no offset on the fixed side for them, in terms of the swap. So it's gotten much more painful. And if your business has been good and you've been able to generate cash, then the thing that you should be doing is paying down some of that debt as it's gotten much more expensive, and or terming it out depending on the price to try to just get it out, extend it out much farther into the future. But today it would have cost you 3 or 4%, a year and a half ago to do that, and today it might cost you 7 or 8.
What do you think happens to the private equity industry and investors in these private equity funds?
My personal feeling, okay, and I think the halcyon days for private equity are done. I just think they're done. Would I go out and say private equity is toast? No, but look, we've had a 20-year run. Private equity guys have done fabulously well. You can know what I do know in all my years in this business. I've operated in a few different leverage strategies, and you cannot run a leverage strategy the same way when you've got 5% interest rates versus when you have zero. The leverage strategies just have to give up the return. So private equity is a leverage strategy. Okay, it works great at very, very low rates. It doesn't work as great when rates are this high because they just can't generate the IRR. So anybody who's allocating money, I constantly read about, I read about pension funds and CIOs of big state funds and college endowments, allocating to new money to private equity. And I said, what, you guys are looking in the rear view mirror. What the returns of the past are not here. The minute we've gone from 0 to 5% on the 10-year, the ability for these guys to generate those 20% plus IRRs is gone. They can't do it, right? Because there's a lot more money out there in the market. It's chasing these deals. The deals are very competitive. The prices that they'd have to pay to actually get companies to sell are too high, and then they can't put the amount of leverage on them to generate the types of returns on the underlying equity that they would like to, and the cost of that leverage is higher. So they've got so many things, that they're facing headwind wise. And I think what you're going to see, there's going to be a generation of private equity, you know, uh, uh, partners and principals who have done fabulously well for the last 10, 15, 20 years. They're all going to sail off into the sunset and live well and hand the keys off to the next generation. And the business will evolve into something else. But if you look back, think about the hedge funds, right? Hedge funds, the same thing happened. I was very fortunate to be at the very, very forefront of sort of the hedge fund, evolution and creation. My partner Carl and I both worked together. When we met, we were working in the convertible bond business at Merrill Lynch back in the 90s. And that was when the hedge fund game really started to take off, because convertible ARB is a natural, it's a fantastic product for the hedge fund community, because you're long the senior asset in the capital structure, you're short the junior asset in the capital structure. You've got this positive convexity where you're able to, to short stock more stock as it goes high, as the stock goes higher, buy it in as it comes lower, trade along that convexity and capture volatility, and lever that strategy up very, very highly to produce incredibly high returns that were non-correlated with the market. So bunch of assets came flying in, and those used to be 2 and 20 strategies, right? The 2 and 20 meaning 2% management fee and 20% of the returns that the manager used to be able to keep. People would give them money on those terms because the returns they were producing were fantastic. More money comes to the market, opportunities shrink over time. What happens? They have to start looking into different asset classes, other ways to sort of generate returns. It's not as easy to do. You can't get as much leverage. What happens? Overall hedge fund returns, they become more disparate. Some guys do really well, other guys do really poorly. So what happens? Well, they're not as special. When you have 20 hedge funds out there that you can invest in, okay, you can command 2 and 20 very easily. When there are thousands, right, and they're no longer that special, why would I pay 2 and 20? If somebody really had something unique, I might pay for it, but everybody else, no, I would pay a lot less for it. And that's essentially what's happened in the hedge fund market. It's gotten very commoditized. There are still pockets of the market where guys still do quite well and are able to command those fees. But overall, you see the returns kind of dissipate. The guys that produce great returns aren't true hedge funds. A lot of those guys are taking big directional bets or leveraging big directional bets and producing different types of returns, and that's fine. The private equity world is going through the same thing, because there used to be a few dozen private equity shops. I mean, there are thousands of them around the world right now, and they're all scouring the market and looking at the same companies. And they used to be able to buy companies and negotiate and buy companies. Well, now the way they buy them is in an auction. Right? If you're buying them in an auction, chances are you're not getting a bargain. You're competing with a whole bunch of other people who have the same financial incentives as you do. A lot of smart analysts doing work, figuring out where we can finance this, and all you're doing is trying to, outguess the other guy as to what it is that I would have to pay to get this into my portfolio. So I'm not particularly sanguine on the outlook for private equity as an investment, as an asset class. The next thing that's coming along is private credit. And private credit is just a natural offshoot that these guys are trying to grow, because many of the private equity shops realize, well, shoot, I can't raise as much money in private equity. Some of these smart people actually really get that I'm not going to be able to produce those kind of returns anymore. So let me give them a credit option that's going to be slightly lower return, but more stable. And there's an awful lot of money that's flooded into that market very quickly as well.
Just how big is the growth in private credit? I know it's big, but just how big?
I mean, I don't even think I can put a number on it, because there's so many pockets of private credit. You have, the original, I don't want to say the original, but in the last 15 years, the main bucket of private credit has been the BDCs.
Mhm.
And the BDCs, business development companies that, like an Ares Capital, as one, um, those are the most visible. And, they've done this for a long time and financed these companies on a private basis.
But they're
You now
also they're public, right?
they're public companies, yeah. So Ares Capital is
Yeah.
symbol is ARCC.
And
Uh,
they're quite leveraged. They borrow money.
they borrow money in the markets, yeah. But Ares borrows. Ares is an investment grade company. It's got a $10 billion equity market cap. They've produced really good returns over a long period of time. The stock, the common stock there yields 10%. So
The
and they
business
and they
development, not Ares, the company, but the
not
business
the company.
development
This
corp.
is Ares Capital Corp.
Yep.
Yes, this is their business development corp, the BDC, and it yields 10%. So, if somebody wanted that exposure to private credit and was a smaller investor, you can get it going to the BDCs, Ares or Prospect Capital. Many of these BDCs have been out in the market for many, many years. They've been consistent dividend payers. There's certainly been volatility in the underlying
Mhm.
equity. There's good times to buy and good times not to buy, but that's where it all started. And now we're in an entirely different regime where huge sums of money is being raised and allocated privately in different types of vehicles. Some of these vehicles require people to lock money up for 2, 3, 5. I've even heard as long as 10 years. Um, and in the last few years, again, when there wasn't a lot of yield around for traditional fixed income strategies, whether they were investment grade or high yield, these guys were able to produce returns that were in excess of that. And so they continued to attract more money. Defaults were low. They also were running a leverage strategy. So they were borrowing money as well as the money that investors gave them to kind of juice returns up. And some of them produce 10, 11, 12, some cases even higher percent annual returns. So money's poured in there. Again, that it's so faster than just about any other asset class I've seen in terms of the overall growth. Now, it's not all homogenized in the sense that some are very specific in the types of transactions they do. I've seen them that are an infrastructure fund, so they're just doing investments in. They could be in toll roads, it could be in gas pipelines, right? So they're very focused industry wise. Others are more focused in terms of size and scale. So we have at the very bottom end guys will only do deals 20 million and under, or at the top you have an Apollo or KKR or sort of Blue Owl, who are
Mm.
kind of three or Ares, three of the big guys there, who are looking to actually usurp the banks in their roles as the underwriters of LBO debt. And they said, well, what we can do is we can actually write $1 billion checks for you guys and provide you with that backstop financing you need in order to get your LBO done. So
And hold on to it and not sell it to see.
concept of private credit is it's extraordinarily broad. It's much broader than than anybody thinks. And I mean, I'm sure there are many facets of it that I haven't even seen um, out there. And I'm in the market every day. So if my concern about private credit is that if people, some of it will work out fine, some of it won't. And if you are an investor and you put money into a private credit fund that requires you to lock it up, well, you may get decent returns. But if you turn around and decide, all right, I want to get out, um, in order to sell it, you may have to go to a secondaries broker who will come in and bid you down 15 or 20% from the net asset value in order to get out. So you're going to give away a couple of years of income to do that. And as I look at the public markets where we live today, the high yield market here is almost a 9%, market. You can invest in a public mutual fund, get 9% and have daily liquidity. It doesn't make a lot of sense for me to tie up money in private credit that's much more opaque, hard to assess and analyze, very limited liquidity, when the public markets are now giving you a much more attractive yield. And by the way, if you want to take no risk, go ahead. You can buy treasuries at over 5% at the short end. You can buy,
Mhm.
today the 2 year is 2-year
5.10.
treasuries 5%, and 6-month treasury bills at 5.25. You can roll treasury bills for a while and say, I'll hang out and get that. So that's my concern with private credit as an investment case today. The asset class, though, is going to be around. It'll be around for a long time. There are some guys in it that are very, very good. And then there are some other people in it who are visitors, and they're sort of newer to the market. And I think they're going to have a harder time both sourcing deals and continuing to raise capital.
So many people are getting into private equity, and there should be a lot of liquidity. But is it fair to say that the liquidity in the loan market is not great, at least compared to 2 years ago? And how come you see some private credit CEOs or investment officers on Bloomberg talking about, I'm so excited about this opportunity, to get 12% yields. How is it that the liquidity is so bad and the opportunity is so great, supposedly, if everyone's doing it?
Good question. So I don't know. Somebody's spinning a better yarn than I can spin, I guess, about why the opportunity is so great. The industry we're in is full of people who are deft marketers, right? They've been out and able to go out and market and spin a story and tell a great story and raise money and hopefully invest in such a way that that their investment returns mimic the spin that they put on their story when they're raising money. And I think that's some of it here in what is leading people to private credit. But I do think that the fact that we haven't seen a lot of defaults will continue to bolster private credit. It's always going to be easier in the rearview mirror to say, oh, it was really good or it was really bad. In my opinion, just happens to be someone who's sitting here and been investing in these markets for all these years, and I've seen the fads come and go. Right? We were talking about this when SPACs were blowing up here 2 years ago. I was losing my mind as I'm watching this. I'm going, okay, so you're going to launch a SPAC and you're going to make Shaquille O'Neal one of the SPAC guys. You're like, yeah. Well, let me tell me what Shaq's investment acumen is here, that somebody should just give Shaq a bunch of money to go out and find a company and be on the board of this to do some kind of deal. I mean,
BODY. I think it's trading less than a dollar. Yeah.
yeah, it was nuts at the time. But that was the economics of the SPAC deals were just crazy. In fact, we had a portfolio company that one of our that a SPAC came. The SPACs were kind of looking at, and we're like, no, we can't do this because it'll destroy the equity. And sure as heck, you can see any company that's even some real legitimate companies that are out there that were bought by SPACs, they still trade with this SPAC taint on them. They all trade at discounts to what their probably regular public market values would be, just because they came as a SPAC, even though that might have been 2, 3, 4, 5 years ago. That SPAC taint just stays with them forever.
Yeah, well, maybe the fail rate, the bankruptcy rate of SPACs that went public, it could be it's high. It's very high.
Yeah, well, there was an incentive. Look, the guys that if you funded a SPAC, it cost the guys to start them probably a couple $1 million of their own money. So they were incentivized to try to find a deal.
Hmm.
And the second thing was the owner's share of the equity and of the economics that they got were astronomical. So if they found any deal, even if it didn't work well, they were still going to be able to generate great economics for themselves. Forget about whatever anybody else ended up with it. That
Yep.
was the residual holders. So
And it went from $10 to $2. It's a buy. Well, the cost basis for the founders in the
yeah,
sponsors is like seven
no, it
cents.
was
So
de minimis, right? It
yeah.
was de minimis. Yeah, and so again, going back to what we were talking about, there's always this latest new thing. Private credit is the new thing, right? SPACs were the new thing for a while. Private equity was the new thing, when it really started to explode, and you had a few different situations that were producing really good returns here, back in the early 2000s. Private credit is because you're getting paid a coupon, right? It's going to generate they're going to generate some okay returns as long as we don't have significant credit events. The returns will be at least okay, and they could actually be quite good. The only question is, what's the portfolio quality look like? We just don't know. I mean, you don't get the same kind of transparency in knowing what, um, where each of these guys are lending. Now, maybe there are some that are going to be extremely transparent. I don't know, but I'm not privy to the portfolio disclosures of a lot of these guys. And of course, there are some that are going to be better underwriters, just like there are, at any of the banks, right? So this is essentially what it's kind of turning into. The banks are no longer going to be in the game, and what's kind of risky for them is if these private credit guys completely usurp them. I'm not sure what purpose we have to have the banks out there in the leverage finance world at all. Right now they're just collecting fees for arranging and syndicating loans. Private credit guys might start doing that and competing with them. They may say, all right, well, we don't want to own this whole thing, so let's syndicate it out and let's see if we can, get some of this out here to the CLO guys, or some other cohort that wants to buy a piece of those loans.
What do you think on the financial sector, and in particularly like banks, bank stocks, the business of banking, where credits losses are coming up, but from a very low level, and also their deposits are going down, deposit costs are going up as private credit is eating their lunch, whether that's a good lunch or not, whether it's a lunch you want to have, their lunch is being eaten.
It's worrisome. I mean, it's worrisome. We don't have any investments at all in deposit taking institutions because of that. We saw. I saw up close and personal. I saw what happened with Washington Mutual when it failed. During the financial crisis, I watched that collapse. I was trading the bonds. Both the opco and holdco debt of that when it was kind of coming unraveled. It was amazing.
And did those bonds both go to zero?
They didn't. There were still assets, I think, if I remember. I think the holdco actually held up okay, but the opcos collapsed and didn't. So, but I can't recall the ultimate unwind and the ultimate recovery in the WAMU paper. But what happened was $17 billion was withdrawn from the institution in, I think, 11 days. Something like that was the number. In the case of First Republic, the number was something like $40 billion in 24 hours.
Silicon Valley Bank.
Yeah, with Silicon Valley Bank. Yeah, Silicon Valley, and then First Republic also, bore a lot of that as well. But to see that much money come out that quickly, the structure of banking has changed. The ability to make and withdraw money on your cell phone that exists today did not exist in the days of the WAMU unwind. So people used to have to actually go to the bank in order to get the money out. Today they didn't. It came out that rapidly. So that kind of was a real eye opener to us about the risk in deposit taking institutions, right? And if things can unravel that quickly, then you really have to step back and think about the whole structure of banking today, and what it is and what it means. They have fewer lines of business that are going to be as profitable as they used to have, right? So securities underwriting fees are actually lower, which is disincentivizing them from making principal investments on that basis. So they don't want to own loans on their balance sheet. They just want to originate, collect the fee, and move on. So the durability, I think, of the franchises really starts to be called into question. Do we need them, the same way that we used to? I'm not sure that we do. So it's a little bit troubling. We also know that there's certainly going to be a lot more regulation coming down the pipe, right? There's got to be, on the back of something like Silicon Valley Bank and Signature and First Republic. Of course, there's going to be some more regulatory overlay in order to protect the depositors and/or just the investors in general from something like this happening. So the banks are going to be required now to operate with much tighter risk controls, and that will reduce their overall returns and profitability ultimately. So net, I think banking is going to be in for a pretty tough road for kind of quite a while. It's not an area of real expertise nor focus for us from an investment standpoint.
Right now, the much of the Treasury yield curve is inverted, although it's exiting inversion. What about the credit spread curve? Like, is it more expensive to borrow now or in 10 years?
So from a spread basis, believe it or not, it's fairly flat. It it's probably a touch tighter here at the front end than it has been, but we look at it. We like to look at things much more on a just an absolute yield basis as to and where we're investing. I use spreads much more as a barometer for me to understand what the market's risk tolerances are, and when we go into sort of more of a risk on or risk off. Are we in a neutral spot? Are we in a very risk on market or very risk off? Right now, we're sort of we're still a little bit risk on, although it's been coming off in the last month, right? So we're moving back more into sort of the neutral phase as the markets overall have really been correcting here for the last call it 40 45 days. But on an absolute return basis, what's interesting is if we can find again these attractive yields at the front end, I don't have to go out too far. And there are certain cases where I'm able to buy bonds that right now I'm looking at something I'm trying to buy right now that's a double B plus company at 7.75% for 18 months, and their 2029 paper also traded 7.75%. So I go, all right, well, I'm happy to take that bird in the hand and stay at the short end without having to get paid 7.75 for the next 18 months. Because if I have to, invest out to 2029 to get it in the same credit, I'm taking an awful lot more interest rate risk and spread risk out there to do that. So
Is that what they call term premium, the academics?
yeah, I guess I don't follow what the academics say too much.
I like that. But so you're saying normally that curve would be slightly upward
Normally, the
sloping?
curve should be up more upward sloping than it
Yeah.
is today, and I'd say in aggregate it's probably slightly upward sloping, but it's flatter overall than it probably has been for a while. And that's one of the reasons why we're able to find some of the opportunities we are in that 1 to 2 year part of the market. We were very active in the commercial paper market
Mm.
for the last sort of 18 months, and companies have stopped funding as much in commercial paper as they used to, as it's gotten more expensive, because most of the commercial paper issuers are investment grade, and so they started to say, all right, well, if rates are going higher, I'm going to start issuing longer debt, and it's not costing me a whole lot more to issue that longer debt than it is to issue the short debt. So the CP market actually is the activity levels have gone down as a result of companies looking to term out their financings a lot more.
It's fascinating, Craig. We'll leave it there. Thank you so much for joining us and sharing your insights, and thank you everyone for watching.
Great. Thanks. Appreciate it.